Portugal's commercial real estate investment remains closely tied to the performance of tourism, one of the country's strongest economic pillars. In August 2025, Portugal welcomed nearly 3.8 million guests and over 10.7 million overnight stays, generating about €1 billion in revenue. Domestic demand was the stabilizing force, offsetting a decline in foreign visitors. At the same time, the data points to moderation. Occupancy rates softened, and revenue growth slowed compared with July. International markets diverged. The US and Canada posted strong increases, while Spain and Italy declined. For investors, this mix highlights the need to track geographic shifts in demand and adapt strategies accordingly. Domestic tourism is still the anchor. Resident overnight stays grew by more than 4%, proving the resilience of local demand. Lisbon and Madeira stood out, with sharp increases in resident stays. For investors, this underscores the importance of assets that appeal to Portuguese travelers, from urban hotels to family-friendly resorts. Internationally, the picture is shifting. The US and Canada grew strongly, while traditional European markets contracted. This means Portugal is relying more on long-haul visitors. Assets in Lisbon and Porto are positioned to benefit most, while properties tied to nearby markets may see volatility. Regional differences are clear. The Centro region declined, partly due to wildfires, while Madeira and Setúbal showed growth. This highlights how climate risks can directly affect performance. Diversification across regions and factoring in resilience is key for long-term real estate strategy. When we look at occupancy, RevPAR, and ADR, the picture becomes more complex. Occupancy rates declined, with bed occupancy at 67% and room occupancy at 73%. RevPAR averaged almost €117, with the Algarve leading. ADR rose to more than €159, with Madeira recording the strongest growth. This combination of falling occupancy and rising daily rates shows operators are prioritizing yield over volume. For investors, this highlights opportunities in premium properties but also risks in weaker secondary markets. Looking ahead, Portugal's tourism sector is expected to remain resilient, but growth will be more selective. Long-haul markets will continue to support premium hospitality and retail, while regional disparities and climate risks demand careful planning. In summary, Portugal's tourism sector continues to support commercial real estate, but investors need to focus on assets aligned with domestic demand and high-value long-haul travelers. Diversify geographically across Lisbon, Porto, Algarve, and Madeira. Factor in climate risks and monitor occupancy and pricing trends closely. Portugal offers strong opportunities, but success depends on a selective, forward-looking approach. For tailored insights and guidance on where to invest in property in Portugal, contact Roker Estate to explore resilient and profitable investment opportunities.